woke up with these data, right? The personal income and consumer spending, and what kind of an effect did we see on the futures and now on the market?
Well, it did cause futures to decline on the release. What happened is that nominal U.S. income for the month of January declined 3.6%, which is an outsized decline. It happened for two reasons. One is the tax hikes that began at the beginning of the year, the increase in the payroll tax here in the United States, and then also income taxes went up. And then also what occurred was because many wealthy Americans knew that these tax hikes were going to take place. At the end of 2012, they pulled forward all sorts of compensation. And the net effect was we had an outsized decline in income. Now, while that was expected, the declines were much larger than the Bloomberg consensus forecast
Are much larger.
Are much larger.
How much are they?
Well, it was a full 1/3 larger.
Oh.
And when you dug into the data, you could see wages actually fell by 0.6%. They were expected to increase by 0.5%.
Okay.
So it clearly indicates there's an issue out there right now that likely is connected to the broader uncertainty about the path of fiscal policy here in the United States and weak demand here in the United States.
So should we tie to the fact that IMF was right, you're right also, in addition to the the sequestration cuts? That's going to happen today. Most probably it's going to happen, right?
Well,
Drew?
sure. Now, at 12 a.m. this morning.
11:59 p.m. is Obama's deadline.
That's
He's
right.
done.
The sequestration officially has started. Now, it means two things.
Yes.
Okay, first is because of the way federal law is set up here in the United States, the layoffs and furloughs. Now, what furloughs mean is that some individuals will be told who work for the federal government that they're going to work 1 day less a week or 1 day less a month. For example, the Department of Defense has said that if sequestration happens, and it's going to happen, that they would likely have to furlough 750,000 workers. That means 750,000 individuals are now going to work 1 day less a week for the remainder of the year.
4 days a week they will work.
That's
750,000.
That's right, and the Department of Justice and National Labor Relations Board have already issued furloughs this morning. So
already, they're ready.
That's right, and we're going to start to see a spate of them over the weekend and in the next week.
And Joseph, what is the way on economy in the second half? That is your report. I have it in my hand. You say sequestration cuts will weigh on economy in second half.
Well,
how and how much is the question, right?
Okay, when you layer the sequestration cuts on top of the tax hikes,
yes,
what you end up with is around a net 2% drag on the overall economy. You'll see a good portion of the sequestration hit late in the second quarter, but you'll see it spread out for the remainder of the year.
So when will it begin to show up in the economic data?
You'll see it in the April data reported in May.
That fast?
Yes.
April data recorded?
We reported in May.
We'll be reporting. And IMF says, you said a drag of, hold on, 2%.
Yes, 2% on overall growth for the year.
I see.
Yeah.
And IMF said yesterday they are expecting a 0.5% reduction. Do you agree with that?
Well, the 2% fiscal drag means over the calendar year. Now they're talking quarter over quarter annualized.
Quarter to quarter.
So a whole 0.5%. Now when you're growing at only 2% or 1.7%, that 0.5% is quite large on a year-ago basis.
There are more pessimistic than.
Well, we're basically around the same.
Almost.
I thought there was a 0.7% year over year, so
yes,
we're right in the same ballpark.
Yes. And as you know, you write here, as the 2.2% figure illustrates, the economy has been unable to sustain growth in this recovery, much above 2%, even with the Fed's.
Even with the Fed's
because of this?
easing.
Is it because of this?
No, the reason why the economy is going slow is the U.S. economy is proceeding through a structural adjustment, where the growth model that we used, that relied on easy credit and overconsumption, is now shifting towards the production of value-added manufacturing, technology, energy extraction, and trade. So the growth model of the United States is going to look very differently 10 years from now from what it did 10 years ago. So it's that shift especially in our labor market, especially in how we spend, that is the primary cause for the 2% rate of growth, or less than 2% rate of growth here in the United States.
So, Joe, some economists say that the housing sector is going to save us from this because this week we had the new, we had the pending, and it all showed a brighter picture. And what is,
I think stating that the housing sector is going to save us is a bit strong. Strong? I think what we have now...
But they said it,
Well, the economists will say lots of things. What's occurring is we've got a modest recovery.
Yes.
In the broader housing sector. Now, first, we've got a real bounce in residential investment, i.e. housing starts. Now, that's sustainable. Now, we're proceeding at around a 950,000 annualized pace.
Yes.
We need to get to 1.3 million, which is what we call the steady-state equilibrium. That's where we should be.
Will we reach there?
We'll be reached at probably mid-2014.
I was going to say when? Mid-2014. Okay.
Now, the problem is that we have many markets that are seeing rebounds in prices, for example, in Las Vegas and Phoenix.
That's right.
In the southwest portion of the United States, which suffered the biggest decline in housing prices. Even though they've seen near 20% bounces, they had near 70% declines. So what's going to occur is the housing sector will add about 2 percentage points to growth. Now that's good. It's better than subtracting. But remember, before the crisis, it was responsible for about 6% of growth. So it's a very different reality. While housing will contribute to the overall growth picture, it's not going to be the driving factor of growth in the economy, nor will it save us.
But then, do you think Fed might, because Fed has been talking about the exit strategy, what is the biggest risk to the housing recovery aside from a Fed's exit?
Well, I disagree. The Fed's not going to exit.
Fed's not going to in March.
No.
So the QE's future is not in March.
No. The Fed won't even begin to taper off their purchases until probably middle of next year.
Okay.
And I think interest rates are going to stay near zero till around 2016. Okay. The biggest risk to the housing market is the overhang of supply still sitting out in the market. Now, we've got about 5.5 million in what economists call shadow inventory.
Yes.
Now, these are non-performing and foreclosed loans that are sitting on the bank's balance sheets. Now, the banks are carefully managing the release of that inventory into the market, and they're largely releasing it through private transactions with with cash investors. Now, the biggest risk is if at one point the banks have to begin to release that inventory at a much more rapid pace. That will cause the inventory levels to rise up, and when you get an increase in supply, what happens? Prices tend to fall. So what's key here is how banks manage the release. Now, the federal government, via Freddie Mac and Freddie Mae, manage the release of all those foreclosures into the broader market. Now, what I think is that they'll continue to do what they're doing, but the overall recovery in the housing market will just take years, not months.
This is really nice wrap-up of actually what we saw this week and what we're going to see in terms of the future. Can we come back to today? Because I read this morning that Congress leaders to meet Obama as U.S. spending cuts begin, but the leaders today won't yield a breakthrough to over the $85 billion in federal spending cuts. What does it mean? The Senate vote wasn't enough yesterday.
What you're seeing is politicians who are probably in a difficult situation, meeting to show they're trying to do something. But neither side's willing to compromise
So we're not going to see any surprise at all, like in the situation of fiscal cliff? You're pretty sure about it. We're done.
What will happen is both sides will wait a couple months to see what the damage is.
Okay.
And once they see, and the lack of spending begins to hit home in some congressional districts, then we may see what U.S. politicians call emergency or supplemental appropriations, in which they allocate new spending to offset.
Spending appropriations? Isn't that March 27th, though? That's still...
Well, the next big challenge is the debt ceiling on March 27th. Now, that's separate and distinct from the fiscal cliff and then the automatic sequestration.
Thank you so much, Joseph, for coming and sharing these valuable information and your report.
Well, thank you.